Welcome back, everyone. We're diving into a fascinating book today, all about the history and future of money.
It's called Layered Money.
Right, by Nik Bhatia.
Have you heard of it?
I have, and I gotta say, it's been a really interesting read so far.
Yeah, Bhatia's got some really interesting ideas about how money has evolved over time and how it all works.
Okay, so before we get too deep into this whole layered money thing, let's back up a bit.
Sure.
How did humans even decide what was money in the first place?
Well, I think the first thing to realize is that money, it's not like this fixed thing, you know?
Right.
It's always been changing. It's always evolving.
Yeah.
I mean, people have used all sorts of things as money throughout history.
Oh, I know, like seashells and
Seashells, yeah.
beads and
Exactly. Beads, livestock.
yeah, all kinds of crazy stuff.
But certain commodities rose to the top because of their inherent properties.
Like gold and silver.
Gold and silver are a perfect example.
Yeah, why those two?
Well, they're durable,
Uh-huh.
they're relatively scarce, and they're divisible.
Makes sense.
You can make coins out of them or bars or whatever you need.
Yeah, but I mean, carrying around bags of gold doesn't sound very practical.
No, not at all. That's where the invention of coins comes in.
Ah, coins. That was a big step forward, wasn't it?
Huge. Standardized weights and purity, suddenly trade becomes so much easier.
Yeah. Can you imagine trying to do business if every coin was different?
Chaos.
Total chaos. But even with coins, there were still limitations, right?
Oh, yeah, for sure.
Yeah.
Two big ones, actually.
Oh, were they?
Well, firstly, you had just tons of different coins circulating.
Oh, yeah, from all over the place.
Exactly. So cross-border trade was a nightmare.
I bet.
And then secondly, transporting large amounts of coins was incredibly risky.
Yeah. Think shipwrecks and bandits and all that.
Exactly.
Oh,
So
wow.
merchants started looking for a better way.
And that's where layered money comes in.
Bingo.
Okay, so tell me more about that. How does this whole layered thing work?
Well, it all started with these things called bills of exchange.
Bills of exchange? What are those like ancient IOUs or something?
You got it. It was basically a promise to pay a certain amount in a specific currency at a later date.
Okay, I'm with you so far.
So instead of shipping chests of gold, you could just trade these bills.
Sounds a lot safer.
Much safer
Yeah.
and more efficient.
So this was like the first layer of abstraction on top of the base layer of like gold or silver.
That's a great way to put it. This is the birth of what Bhatia calls second layer money.
Interesting. And this caught on?
Oh, yeah, big time.
Yeah.
Bills of exchange revolutionized international trade.
They definitely.
Reduced risk, provided flexibility.
Less chance of getting robbed.
Exactly.
So it's kind of like the precursor to our modern banking system.
You're on the right track. And speaking of banks, that's where we start to see the emergence of central banking.
Oh, central banks. This is where things get really interesting.
Yeah, the power dynamics start to shift.
Okay, so where do we see this shift taking place?
Well, Bhatia highlights the Bank of Amsterdam, established in 1609.
The Bank of Amsterdam.
Yeah, and what's really interesting is that it was actually the world's first stock market that kind of spurred its creation.
The stock market created the central bank.
Kind of. The Dutch East India Company had just issued shares.
Oh, right, the Dutch East India Company.
And there was this sudden surge in financial transactions.
So they needed a better way to settle all those trades.
Exactly. And that's where the Bank of Amsterdam stepped in.
Okay, so what did they do?
Well, they essentially had a monopoly on issuing what we now consider second-layer money.
So their own currency, backed by gold and silver.
Yep. They called it the guilder.
The guilder. And what's really remarkable is that they were the first to offer instant transfers between accounts. Wow, no more lugging around those heavy sacks of coins.
Right. It was a game changer.
I bet it made things a lot faster and easier.
It did. But there was a potential downside, too.
Oh, there's always a downside, isn't there?
This newfound power, it also introduced what Bhatia calls privileged lending.
Privileged lending. What's that?
Basically, the bank was creating money for favored entities, often tied to the government.
Sounds a bit shady.
It raises questions about fairness and control that we're still grappling with today.
It's amazing how these early dilemmas still resonate in our modern financial system.
Right. And here's another interesting tidbit.
Okay, I'm listening.
The Bank of Amsterdam eventually stopped people from withdrawing their gold altogether.
Wait, they just said no more gold for you.
Pretty much. But here's the key takeaway. They were able to do this because people trusted the system so implicitly.
Wow, so they didn't even feel the need to redeem their guilders for actual gold.
It highlights a fundamental truth about layered money. It relies on trust more than the physical asset backing it.
So even back then, trust was the real currency.
I think that's a really profound insight.
Yeah, it is. And it's fascinating to see how these early monetary systems are setting the stage for what we have today.
It's all connected. And this is just the beginning of our journey.
I can't wait to see where it goes from here.
Me neither.
Okay, so we've got this the system of layered money emerging in Europe, but how did the US dollar get involved in all of this?
That's a great question. And it's really a story of, well, kind of two things happening at once.
Okay, lay on me.
On one hand, you have the U.S. economy just exploding in the late 19th and early 20th centuries.
Becoming an industrial powerhouse.
Exactly. And with that growth comes a huge demand for dollars.
From the rest of the world?
From all over. They needed dollars to buy American goods and invest in American companies.
Makes sense. So the dollar's gaining traction, but the U.S. still doesn't have a central bank, right?
Not yet.
Yeah.
But that's all about to change thanks to, well, a rather unexpected event.
Oh, what was that?
The San Francisco earthquake of 1907.
The earthquake? What does that have to do with the dollar?
Well, it triggered a major financial crisis. Insurance claims from Europe suddenly put a huge strain on the dollar.
Okay, I see.
And the Bank of England, sensing an opportunity, raised interest rates.
To attract capital back to the pound.
Exactly. And it almost brought the American financial system to its knees.
Wow, so this natural disaster ends up shaping the future of global finance.
You got it. It really exposed the vulnerabilities of a system without a lender of last resort.
So they realized they needed a central bank.
Yep. And that led to the creation of the Federal Reserve in 1914.
The Fed. So how did they approach this whole idea of layered money?
Well, they basically took the existing model and kind of Americanized it.
Okay, what do you mean?
So at the base, you still had gold, the ultimate source of value.
Okay.
Then on top of that, you had the second layer, Federal Reserve notes, which is basically the paper money we use today.
Okay, so far so good.
And then finally, you had the third layer, where private banks could issue deposits and other forms of credit.
So pretty similar to what was happening in Europe.
Very similar.
Hmm.
But the Fed also introduced a crucial distinction: wholesale versus retail money.
Wholesale versus retail? I'm not sure I follow.
So wholesale money refers to the reserves that banks hold at the Fed,
Okay.
while retail money is the cash we use for everyday transactions.
I see. So they were separating the money used by banks from the money used by the public.
Exactly. And this would become really important as the dollar's global role expanded.
Interesting. But what about gold? It was still the bedrock of the whole system, right?
Well, that's where things get even more interesting because, well, the Great Depression kind of throws a wrench in the works.
Ah, the Great Depression. That was a pretty tumultuous time.
To say the least. And it really put a strain on the dollar's link to gold.
How so?
Well, in 1933, President Roosevelt issues Executive Order 6102.
Executive Order 6102. What did that do?
It made it illegal for Americans to own gold.
Whoa! They just outlawed gold.
They did. The government argued it was necessary to stabilize the dollar and fight the Depression.
So they essentially took control of all the gold.
Yep. And they devalued the dollar against gold, hoping to boost exports.
Okay, so the link between the dollar and gold was broken, at least for American citizens.
But internationally, things were still kind of tied to gold.
For a while, at least.
Right. But that brings us to another pivotal moment. The Bretton Woods Agreement of 1944.
Bretton Woods. Okay, I've heard of that, but I'm not entirely sure what it was all about.
This agreement basically establishes the U.S. dollar as the world's reserve currency.
So it officially replaces gold.
Pretty much. The U.S. emerged from World War II as the dominant economic power, and the dollar was seen as the most stable currency.
Okay, that makes sense.
So under the Bretton Woods system, other countries could exchange their dollars for gold at a fixed rate.
Interesting. So it was still kind of based on gold, but the dollar was now the main player.
That's a good way to think about it. It was a gold-backed dollar standard.
But you mentioned earlier that this new global role for the dollar also brought some challenges.
Oh yeah, big time. As the dollar's influence grew, it started to operate beyond the direct control of the Federal Reserve.
Wait, what does that mean?
It led to the emergence of what are called offshore dollars or euro dollars.
Euro dollars. I've always been a bit confused about those.
They're basically U.S. dollars held in banks outside the United States.
Okay.
So you've got this whole parallel shadow banking system developing.
Outside of U.S. regulations.
Exactly. It's like a whole financial universe running alongside the official system.
And this is where things start to get a little bit risky.
You could say that.
Okay, so these euro dollars are outside U.S. regulations.
Exactly. And that's where things start to get really interesting. Because all of a sudden,
Wow.
you have this massive pool of capital just sloshing around the globe with very little oversight.
Sounds like a recipe for trouble.
It was.
Yeah.
And it fueled a lot of a lot of risky lending practices,
Yeah.
especially in the repo market.
The repo market. Remind me what that is again.
Sure, so repo stands for repurchase agreement.
Okay.
And it's basically a way for banks to borrow money using their assets as collateral.
So they're leveraging their assets to get more loans.
Exactly, and this could be really dangerous if those assets start to lose value.
Like what happened with the housing bubble.
Bingo. When the housing market collapsed, all those mortgage-backed securities that banks were using as collateral suddenly became worthless.
So the whole system just froze up.
Pretty much. Nobody wanted to lend to anyone because they were afraid of getting stuck with toxic assets.
And that's when the Fed had to step in.
Yep. They became the lender of last resort, pumping trillions of dollars into the system to prevent a total meltdown.
It was a pretty dramatic moment, wasn't it?
It was, and it really highlights the fragility of our financial system.
Yeah, and all this is happening right before Bitcoin comes onto the scene.
Which is, it's really quite remarkable when you think about it.
Yeah, Bitcoin, this decentralized digital currency immune to government control. It's like it was tailor-made for that moment.
It's almost poetic, isn't it?
It is. But beyond the philosophy, what are the practical implications of Bitcoin for everyday people?
Well, I think one of the most exciting developments is the Lightning Network.
A Lightning Network. Tell me more about that.
So it's basically a second layer on top of the Bitcoin blockchain,
Yep.
and it allows for near instantaneous transactions with very low fees.
So it's making Bitcoin more practical for everyday use.
Exactly. You can use it to buy coffee or groceries or anything, really.
Wow, that's a game changer. And it's all happening without any central authority.
That's the beauty of it. It's a true peer-to-peer system.
Incredible. But what about these CBDCs that we hear so much about? How do they fit into all of this?
CBDCs. Central Bank Digital Currencies.
Right. It seems like every central bank in the world is working on one.
They are. It's their way of trying to stay relevant in the face of all this digital disruption.
So it's like a digital version of their existing currency.
Exactly. And it could potentially offer some benefits like faster payments and lower costs.
Interesting. But it also raises some concerns about privacy and control.
Oh, absolutely. If a central bank controls the digital currency, they could potentially track every transaction you make.
Yeah, that's a bit Orwellian.
It is. But it's a trade-off that we're going to have to grapple with as we move towards a more digital world.
So it seems like we're heading towards a future where we have a lot of different options when it comes to money.
That's what Bhatia calls freedom of currency denomination.
Freedom of currency denomination. I like the sound of that. But it also sounds a bit overwhelming.
It can be. But I think it's ultimately a good thing because it gives us more control over our own finances.
Yeah, that's true. It's all about being informed and making choices that align with our own values.
Exactly. Do your research think critically and choose wisely?
Well said. This deep dive has been absolutely fascinating. I've learned so much about the history and future of money.
Me too. It's been a pleasure chatting with you.
Likewise. And thank you all for listening to our deep dive into Nik Bhatia's Layered Money. It's a truly thought-provoking book, and I highly recommend checking it out.